Every year, hundreds of thousands of businesses launch with one thing in common. Their founders have a clear picture of what they want to sell, and no clear picture of how much they need to sell before the business stops losing money. This is not just a startup problem. It is a problem that appears in every capital investment decision, every new product launch, every expansion into a new market, every strategic initiative that requires upfront spending in exchange for future returns. When a media company launches a new streaming service, the question is not just how many subscribers they can attract. The question is how many subscribers they need to cover the cost of content, technology, marketing, and operations before they begin earning a return. The subscriber count that answers that question is the break-even point. When a pharmaceutical company decides whether to pursue a new drug candidate through clinical trials, the question is not just whether the drug will be effective. It is whether the expected revenue from the drug at the expected price and adoption rate will eventually exceed the cost of development, regulatory approval, and commercialization. The calculation at the center of that decision is break-even analysis. Break-even analysis is one of the most fundamental financial frameworks available to any business professional. It is not complicated, but it is consistently misunderstood, misapplied, and overlooked, often by the people who most need it. Welcome to The Catalyst. This is episode 26. Today we cover break-even analysis, the core concepts of fixed and variable costs, the contribution margin, the break-even formula, how to read a break-even chart, and how to use break-even thinking to make better pricing, investment, and scaling decisions. Break-even analysis rests on three concepts. Understanding each one precisely is the prerequisite for applying the framework effectively. Fixed costs are costs that do not change with the volume of output. Whether you sell 1 unit or 10,000 units, fixed costs remain constant. Rent for a production facility is a fixed cost. Executive salaries are fixed costs. Software licensing fees, insurance premiums, depreciation on equipment. These do not vary with production volume. Fixed costs must be paid regardless of whether the business sells anything. This is the critical characteristic of fixed costs that makes them strategically important. They are incurred before the first unit is sold, and they continue regardless of sales performance. A business with high fixed costs needs a higher sales volume to reach break-even than a business with low fixed costs, all else being equal. The airline industry's structural difficulty, which we discussed in the Porter's 5 Forces episode, is partly explained by its very high fixed cost base. Aircraft, maintenance, airport fees, and crew contracts that must be paid whether the planes are full or empty. Variable costs are costs that change directly with the volume of output. The raw materials used to produce each unit are a variable cost. The labor directly involved in producing each unit is a variable cost. Packaging, shipping, and sales commissions that are paid per unit sold are variable costs. If you produce nothing, you incur zero variable costs. Double your output, and your total variable costs approximately double. The distinction between fixed and variable costs is not always clean. Some costs are semi-variable, fixed within a range of output, then stepping up at a threshold. A factory might operate with one shift until capacity is reached, then require a second shift, a step up in what had been a fixed cost. These semi-variable costs require care in break-even modeling, but the fundamental framework still applies. Contribution margin is the difference between the selling price per unit and the variable cost per unit. It answers the question, for each unit sold, how much money is available to contribute toward covering fixed costs. Once fixed costs are fully covered, the contribution margin on each additional unit sold flows directly to profit. A product that sells for $50 and costs $20 in variable costs per unit has a contribution margin of $30. Every unit sold contributes $30 toward fixed costs. If fixed costs are $300,000, you need 10,000 units sold to break even. 12,000 units sold produces $60,000 of profit. 8,000 units sold produces a $60,000 loss. The break-even formula is break-even point in units equals fixed costs divided by contribution margin per unit. Or expressed in revenue terms, break-even point in revenue equals fixed costs divided by contribution. Margin ratio, where the contribution margin ratio is the contribution margin per unit divided by the selling price. The break-even chart makes the formula visual. The horizontal axis represents units sold. The vertical axis represents money. A horizontal line represents total fixed costs, constant regardless of volume. A diagonal line starting at the fixed cost level and rising represents total costs, increasing with each unit produced. A second diagonal line starting at zero and rising more steeply represents revenue, because the selling price exceeds the variable cost per unit. The point where the revenue line crosses the total cost line is the break-even point. To the left of the break-even point, the business is losing money. Total costs exceed revenue. To the right of the break-even point, the business is making money. Revenue exceeds total costs, and the margin between the two lines represents profit. The gap between the actual sales volume and the break-even point is the margin of safety, the buffer that protects the business against a revenue decline before it enters loss territory. Break-even analysis has four primary strategic applications. Pricing decisions. The break-even formula makes explicit the relationship between price, cost, and volume. If you are considering lowering your price to increase volume, the break-even analysis shows you exactly how much additional volume you need to maintain the same total profit. Reducing a product's price from $50 to $45 reduces the contribution margin from $30 to $25. A 17% reduction in contribution margin, which means you need to sell 17% more units just to maintain the same profitability. This calculation should be done before any pricing decision, not after. Investment decisions. When a business is considering a capital investment, new equipment, a new facility, a new technology platform, break-even analysis shows how long the investment will take to pay for itself. Uber's investment in autonomous vehicle research required a break-even calculation on the cost of development versus the expected reduction in driver costs at scale. Netflix's investment in original content production requires a continuous break-even calculation on content cost versus subscriber acquisition and retention benefit. New product launches. Before committing to a product launch, break-even analysis answers the fundamental commercial viability question. At the price we intend to charge, and with the cost structure we expect to have, how many units do we need to sell to recover our investment? If the required volume exceeds what the market is realistically capable of providing, the product either needs a different price, a different cost structure, or a different product definition. Make or buy decisions. When a business is considering whether to produce something internally or outsource it to an external supplier, break-even analysis provides a precise answer. Internal production typically has higher fixed costs and lower variable costs per unit. External production typically has lower or zero fixed costs, but higher variable costs per unit. There is a specific volume above which internal production is cheaper and below which external production is cheaper. That volume is the break-even point of the make or buy decision. and it should be compared against expected actual demand before the decision is made. Break-even analysis is powerful, but it has limitations that practitioners need to understand. First, it assumes a single product or product mix. In multi-product businesses, the contribution margin varies across products, and the overall break-even point depends on the proportion of sales from each. Changes in product mix, selling more of a lower margin product, for example, can raise the effective break-even point without any change in volume. Second, it assumes linear cost and revenue relationships. In reality, economies of scale reduce variable costs at higher volumes. Fixed costs may step up at capacity thresholds, and price may need to be reduced to attract higher volumes. A sophisticated break-even model accounts for these non-linearities. Third, it is a static snapshot. Costs change, prices change, and competitive conditions change. A break-even calculation done at product launch may be significantly wrong 18 months later if input costs have risen or competitive pressure has required price reductions. Break-even analysis needs to be revisited regularly, not treated as a one-time calculation. 5 things to carry from this episode. 1. Break-even analysis is not just a startup tool. Every pricing decision, every investment decision, every product launch, and every make or buy decision benefits from a clear break-even calculation. It is one of the most universally applicable financial frameworks in business. 2. Fixed costs are the risk. The higher the fixed cost base, the higher the sales volume required to reach break-even, and the more vulnerable the business is to a revenue decline. Understanding your fixed cost structure is understanding your financial risk profile. 3. Contribution margin is the lever. The contribution margin per unit, the difference between selling price and variable cost, directly determines how many units you need to sell to cover fixed costs. Pricing decisions that reduce the contribution margin require volume increases that are often larger than intuition suggests. 4. The break-even point is the floor, not the ceiling. Reaching break-even means you have stopped losing money. It does not mean you have generated a return on investment or created shareholder value. The business case for any initiative needs to demonstrate not just the break-even point, but the expected profit at realistic sales volumes. 5. Your action. Take one product, service, or initiative you are currently involved with. Estimate its fixed costs, its variable costs per unit, and its selling price. Calculate the contribution margin and the break-even volume. Then ask, is this realistic given what we know about the market? If the break-even requires volume that exceeds credible demand, the initiative needs to change before it launches. That brings us to the end of this chapter of The Catalyst. Over these 11 episodes, we have covered some of the most powerful and widely applied business frameworks in the world. From the McKinsey 7S model to break-even analysis, from blue ocean strategy to design thinking. Each of these frameworks gives you a new lens through which to see the business problems and opportunities in front of you. But frameworks are only as valuable as the thinking you bring to them. The real work is in applying them honestly, with real data, real conversations, and the willingness to see what is actually true rather than what is comfortable. That is what The Catalyst is about. Not just frameworks on a screen, but the discipline of clearer thinking, better decisions, and more confident action. If this series has been useful to you, share it with someone in your network who would benefit from it. Subscribe to stay connected, and keep building the thinking tools that will define your next level. This has been The Catalyst. See you in the next series.